So hello learners, welcome again to Manifested e-learning platform, and today we are going to continue with our revision. We are going to look at May 2018, that is question number 2. So the question reads like this: Mafuta International Limited, a petroleum exploration company, provided the following financial information for the year ended that 1st December 2017. Crude oil exported 1,400,000 barrels. Crude oil sold locally for further refining 750,000 barrels. Exploration costs shilling 16 million. Incidental income from petroleum operations, that is 1,250,000. Management and administration expenses, that is 14 million. Depreciation is 750,000. Provision for bad debts, both general and specific, is 2,450,000, but for specific it is 1,250,000. Non-productive rent, we have 1,156,000. The schedule of qualifying capital expenditure was provided as follows. So we have capital expenditure item, date of acquisition, location, and then we are given the amount. The first asset is plant and machinery that was bought on 1st July 2015, offshore. The cost is 6 million. Furnitures and fittings bought on July 2015, onshore, 2 million. We have buildings acquired on February 2016, onshore, 4 million. Pipeline and storage tank, date of acquisition February 2017, offshore, at a price of 4 million. Additional information: the international market price of crude oil during the year was 12 shillings per barrel, US dollars. The average exchange rate of US dollar to Kenyan shillings is $1 is equal to 105 Kenyan shillings. The crude oil sold locally was disposed at a price of Kenyan shillings 35 per barrel. Required for 12 marks, calculate the tax liability or a refund for Mafuta International Limited for the year ended that 1st December 2017. Then part B, one of the tax incentives provided to oil and gas exploration companies is the capital allowance on extraction expenditure. Discuss 4 other tax incentives provided to oil and gas exploration companies in your country. So we are going to start with question number A, whereby we need to get the taxable income of this particular petroleum company. The way we calculate the tax liability, remember, petroleum companies are taxed out of their income that they generate, and we need therefore to calculate their taxable profit. Then out of that taxable profit, we multiply it with the corporate tax rate to get the tax liability for the period. In this case, because this is a local company, we will calculate the tax at a rate of 30%. The other thing is we are given incomes and we are also given costs. So what we are going to do is to get the incomes, we less allowable expenses, so that we can get the taxable profit. Then out of that, we calculate the tax liability. So my question is on May 2018, question number 2. We have Mafuta International Limited, Mafuta International Limited computation of taxable profit or loss. If it is a loss, we put in bracket, for the year ended that 1st December 2017. So we can have particulars here, and we have shillings here. So we are saying we are going to use direct method. Direct method. And direct method means we will get the taxable incomes and we less the allowable cost. One of the taxable income is crude oil exported. That is how we have crude oil exported. At the crude oil exported, we exported 1.4 barrel, and 1 barrel is exported at a price of 12 shillings per barrel US dollars. Sorry, at a price of 12 US dollars per barrel. So we multiply by 12. And because we want the taxable income in Kenya, we convert it to Kenyan shillings. And the exchange rate is 105. So we multiply by 105. We get the taxable income. So we have 1.4. We multiply by 12. You multiply by 105. So you get 764,000. 764,000. So the second income is crude oil sold locally. Crude oil sold locally. And the crude oil sold locally is 750 barrel. And in our note number 2, we are told crude oil sold locally was disposed at 35 per barrel. So we multiply by 35. So we get 750. We multiply by 35. 26, 250. 26, 250. Then the other income is incidental income. Incidental income. And the incidental income is 1,250,000. 1,250,000. And we do not have any other income, so we have gross taxable incomes. Gross taxable income. The gross taxable income is 1,764 million plus 26 250,000 plus 250,000. So you get 1,791,500,000. We less now allowable cost. Less allowable costs or expenses. Less allowable cost or expenses. And in our question, the allowable cost that we have is we have exploration costs. Exploration costs. And the exploration cost is 16 million. 16 million. Then the other one is management expenses. Management expenses. This management expenses is 14 million. 14 million. 14 million. Depreciation is not allowable. Provision for bad debts. We only allow specific provision for bad debts. Specific provision for bad debts, which is 1250. 1250. Non-productive rent is not allowable. So the other item that we need to raise is capital allowances. Capital allowances. And for the capital allowances, we are going to consider the assets that we have